So this is a video series that I'm creating to share the entire process of how to finance a multi-million dollar acquisition. If you find a deal, a business that you want to buy, and it's a profitable business that's producing millions of dollars a year, it has a good profit margin, and you have managed to negotiate a good price in which you want to buy this business, and now is the time that you are going to a bank looking for financing. And this is a video series where I'm going to be talking about the entire process, also how the banks are structured, how do they make money, what is their decision making process based on. And there are a lot of misconceptions in this area, which after I clear this, you would be able to understand exactly how the process of fundraising works, how the banks think, their ideology, their philosophy, and their business model. And once you understand this, your ability to be able to leverage that to fund your deals and generate wealth, create wealth for yourself, is going to be absolutely enhanced. So this is a video series about that. It's going to be multi-part. And for those of you who don't know, my name is Prithvi Chauhan. I'm the founder of a healthcare investment company. And I have engaged in over several hundred presentations, financial presentations. I've met over 80 bankers. I've met most of the major banks in the UAE. There are over 26 banks in UAE. I have met about 21 of them, and I have negotiated with some of the largest banks in the UAE. I've also managed to secure a term sheet to finance a $10 million transaction. Now, we did not pursue that transaction because later on we found out some legal issues, but we managed to secure a term sheet to finance that deal, 70% of that deal. And this is one of the largest banks in UAE, and to do this I had to go through several banks at several levels and several divisions. And I have met bankers that have financed $300 million deals. I have met bankers that only deal with billion-dollar groups. I have met bankers that their minimum ticket size criteria to even look at a deal is $50 to $100 million. So those are the types of bankers that the general public is not exposed to. Even the divisions in which these bankers operate, most of the public is not exposed to. And most of the public is exposed to getting a car loan or a credit card loan or a house mortgage, and those tend to be very small bankers. Or if you are a small business owner, you could go to the SME division, small to medium sized enterprises division. Again, these are very small loans, but I'm talking about the investment banks, the big behemoth banks. And I've also met some of the major banks in the world, including Citibank, HSBC Bank, Credit Suisse, Standard Chartered, and I've talked to the bankers within these banks also in senior positions. And I will be talking about, I'm creating this whole series where I will break down the process, why banks, why we go to banks, what is their role in us creating wealth for entrepreneurs, especially entrepreneurs who want to get into the business of buying assets and accumulating assets and starting an investment company. So if that's you, stay tuned. I'm going to be creating this whole series where I will break down the entire process as well as how the banks are structured and what do they expect. So I'll talk to you soon, and yeah, I look forward to making this video series. Cheers. Okay, it's show time. So in this video, I'm going to be talking to you about how to use banks to get rich, how to use banks to create wealth. And this is a whole multi-part series, and this is part one. And in this particular video, I'm going to be giving you an overview how you can use banks, leverage the money that's in the bank to buy multi-million dollar asset and acquire ownership in several assets. And that's how you get rich. Ultimately, richness is going to come when you have ownership in assets, whether it's a real estate play, which is very popular these days, or it's a company that's producing a lot of cash flow. And how do you get into a position of acquiring and owning these companies, especially when you have very limited resources? You have to engage resources that are already in the market, and banks is one of them. And if you look at all the wealth of a nation, most of the wealth of the nation is with the banks. That's where it's kept, and a lot of it is also kept with the government. So I'm talking about liquid cash. Even assets are part of wealth. But if you want to talk about liquid cash that can be used in so many ways, all of that is situated in this institution called a bank. You already know that. So when we go out into the business world and we look out, and when I went out into the business world, I was looking at the business world from a lens of the resources that I had at that time. So I was only looking at it from a perspective of what I have in my bank. And if you look at the world from that perspective of what you currently have, the world looks like everything is out of reach, everything is expensive, everything is something that you cannot afford. And how do you go buy yourself a building and do anything? Because the money that you have is this much, enough for survival. So where is the possibility of hyper growth? Financial growth. Where is that possibility? The moment we talk about that possibility of hyper growth and creating wealth, the external financial institutions come into the picture. And the whole subject of corporate finance talks about how to bring in this capital for the purposes of creating growth, not for the purposes of buying toys or buying houses that you can live in. That's not why you use banks or why you use debt. You could, but it's not the wise way to use it. The way to use it, debt, is to buy assets that produce cash flow so that the debt can be repaid by the cash flows of the thing that you're buying. And if you buy a car using a loan, the car is not producing any money. It's a stupid structure where you borrow something and you buy something that doesn't produce money and it goes down in value over time, and you pay it with your time. You're working on a 9 to 5 and you pay it from that. That's why debt tends to have a very negative reputation. Not because debt is bad, because debt is used in a bad way. But the rich use debt in a completely different manner. They use it to buy cash flow producing asset. The first evaluation is this thing going to go up in value over time, or is it going to go down in value? Is this thing producing cash flow, or is this thing not producing cash flow? Is this thing going to make me richer or make me poor? These are the first questions. So whenever we are looking to go into a hyper growth mode, outside money, we have to talk about outside money. Not just the resources that we have currently in our bank, but the resources that we can get access to, and maybe we don't know how to get access to them, but they are within the reach. And how to get access to them, those resources, and how to understand these instruments of finance, like debt, like equity. Equity is money that you raise from an investor and you give out shares. That's one way to bring in money. Another way is to borrow it. And that's debt, that's equity. There is
also bonds, there is mezzanine financing, there is all kinds of financial instruments. The more I spend time in the market, the more I understand these. So once you know how to play with these instruments, you have many ways of bringing in capital. The one way of bringing capital most people know is through a salary. You know, you work, you give your time, you get a salary. Or you make a lot of phone calls, you make a sale, and that's another way. But there are people who have almost made a promise, they have taken a swear that we will never borrow money. You know, if you borrow money, you go down. And I was one of those guys who said, I'm never going to borrow. But it's irrational. If you have legitimate intentions, if you have a legitimate business, and if you have something valuable that you're buying at a discounted price and it's producing cash flow, and you have done the numbers and it works out, and the risk is low, then there is no reason why you wouldn't borrow, because you are essentially buying a cash machine, not a car. So this is why banks come into the picture, because we are interested in a hyper growth. And I'll give you one more example of why banks are important. Suppose you want to buy something with your money, and let's say that thing is very big in size, like a house. And you calculate, with the current rate of income, I have to spend 20 years to buy that house, to save up enough money to buy that house. So there are people who work 20 years and wait 20 years to get what they want, the house. And then there are other people who just borrow the money, get into the house first, and then they wait inside the house 20 years and they keep working and they pay off. So in other words, when you use debt, you can bring what you want from way ahead in the future into the present. That's the power. Now, what you want, is it good for you or not? That's debatable. Okay, whether it's a car or a house, whatever you want to buy, is that good for you or not? Makes you richer or not? Is it risky or not? That's debatable. But essentially, you're bringing the future into the present, or you're bringing future closer to you. And that's the power of debt. That's the power of external capital. And it can be used to make money. It can also be used to lose money and make you actually poorer, but it can be used to make money. And we are, in this video series, we're going to talk about how it can be used to make and multiply your wealth and go into an exponential growth. There are risks involved. Obviously, you need financial advice, you need legal advice, you need operations advice, you need to have experts on your board, on your team that have done this, that have 25, 30 years of experience each. So you're very well protected, and you have to look at various factors inside a deal to be able to make it successful. And then once you buy an asset, you got to manage it, run it, you have to do all kinds of evaluation. But principally, debt can be used to get rich. And this is a trend that I have seen in several companies. And somehow, the smaller the company, the more debt averse they are. And the bigger the company, they have used debt to grow to that size in such a short period of time. Because if you calculate your little salary coming in or a little sales coming in and only rely on marketing and sales, you pay in time. And you can get money back, but you can't get time back, right? So one of my other mentors, he said, nothing is for free, you always pay. You either pay in money or you pay in time. You decide what you want to pay with. So when you don't raise money, you will pay with time, because to come up with that type of money, you have to work to generate that money, or you could borrow the money that already exists. So we're going to talk about how to make use of this. And before we approach the banks, before we knock their door, before we make that phone call to a banker, we have to understand how banking works. We have to understand how the whole system works and what are their motivations. Because if you want to sit in front of someone, a banker, you have to know what makes him tick, what gets him excited, what is he looking for, what does he need, what are his personal motivations, and what are his professional motivations, and what is the position that he is obligated by, and who is he obligated to, and how is all of this interconnected, and what can he do, what can he doesn't do, what are his fears, what are his concerns. To understand this, we have to understand how banks make money, we have to understand how bankers make money, and we have to understand what are they looking for. And if we can give them what they're looking for, then they will give us what we are looking for. Okay, we have to tie their interest with our interest. So when I initially started out wanting to talk to a bank, I was like, why would these guys first talk to me? Even if I get them to talk to me, why would they give me an amount? At that time I was looking to raise $10 million. Why would they give me $10 million? My assets are not worth $10 million. And at the time, and I was like, how am I going to, like, what am I going to back that loan with? It just did not make any sense to me. But I was doing it because I was told, and I had a system that I was following, and it worked. So I just was working the system. But I almost felt guilty. You often feel guilty when you ask for money, from a friend or someone. If you borrow money, you feel guilty. If you make a sale, you're giving something in return, so that guilt is not there. But when you borrow it, you're not giving anything in return immediately. You will be giving over time. So I was going through a guilt, a moral dilemma, fear, and lack of understanding of what the hell is all of this, And I had the strategy and it worked, but I didn't have the understanding or the rationale behind it. So I'm going to talk about the rationale, so that when you sit in front of the banker, you're seated in a position of power, because you know where your leverage is. You know what you bring to the table, and you know how that thing is important to the bank, how the bank makes money from it, and how the banker makes money from it. So it's actually a profitable thing for the bank to lend you money. So we're going to understand that. So bank makes money few ways. You deposit money in a bank, it's in a pool. The bank borrows money from the central bank, and it has a big pool of capital. And it's kind of like rotting, because liquid cash goes down in value if it's not used. And they are paying interest on the money that they borrowed from the central bank. And the only way they can make this money back is if they push this money out in a way that more of it comes back. And they have to multiply this money. They're obligated, they are in pressure to multiply this money faster than the interest that they're paying to central bank. And so they have to come up with ways to multiply this money. So that's one way they make money, is by lending it out and making interest. The other way they make money with this is through transaction fees. You make a transaction and you have a fees. That's how the bank has a fees. That's how they make money. Another is currency. If there is a change in currency, their currency rates are high, they make money there. And also they make money, giving credit cards and the fees, transaction fees on that, and also interest on that. So these are the ways. There are more complex ways where they have advisory functions, advisory divisions, where they give advice to a bank on how to turn the business profitable. So if there is business they have given a loan to, and that business is not doing well, and they want to make sure that the business doesn't go into bankruptcy, because then they will not get their money back. So they will send their advisors, and they will try to fix the situation, and they will charge that business advisory fees, and they will renegotiate the loan, maybe get a higher interest, more fees, and they try to get more and more money out of this transaction. So they have to lend money to make money. They're under a lot of pressure. So they're looking for opportunities where they can multiply the money. And the bankers, how they are compensated is they get a salary, and for every transaction that they work on to allocate capital, they have a bonus associated with that transaction. So the banker actually makes money if he writes you a loan, but he gets in trouble if that was a bad loan, if you should not be getting that money, if the business opportunity wasn't good and he loses that money, then he gets punished. But if he makes good decisions, and if he makes, and if he makes the loan, he gets a bonus, and when the money comes back, it's all good, and he gets graduated to higher and higher positions. So the banker is also has fear when he meets you, and he has also greed because you are coming up with an opportunity, and he's a little bit skeptical and fearful. But this is how the banks make money. And if you have a deal, if you have a business that you have identified that's producing cash flow, that is producing big margins, then it's in the bank's interest to lend you money. And the other distinction is that the bank is not lending you money, the bank is lending the business money. You just happen to be the one who found out about that business and presented the case. So you're not really presenting yourself, you're presenting this business. And the bank is not interested in your report card. The bank is interested at looking at the financial statements of the business that you have identified. So as long as you have that, and the other principle is that the bank wants to give out, let's say there is an asset which is valued at $1 million, the bank wants to give you $500,000 to $700,000. And the bank will take that asset as the collateral. So watch this. They take an asset which is valued at 1 million, and this asset is going to go up in value over time. So they take that as a collateral, and they give you only $500,000 or $700,000 cash, which goes down in value. So first of all, what they are paying is less than what they are getting, and what they are getting goes up in value, and what they are giving goes down in value. And you have to multiply that money and pay it back. That's banking. And that's how they make money. They get bigger and bigger asset chunks, give as little money out as possible, and charge as much interest and as much fees as possible. And if something went bad, they'll keep this asset. And over time, if this asset is going up in value, they'll actually make much more money. And one of my finance directors, he told me, Prithvi, for banks, this real estate and these assets are like candies and chocolates. They want all of it. They want to give as little money as possible and take as much assets as possible. And because psychologically we value money, we, they show us this little candy money, and we start giving all our assets, and they start taking over the assets. And this is the whole principle on which lending happens. They want bigger assets, but they want to give little money. So you're fine with that, you will work with that system as long as it's not your asset. Because you're not putting anything on the line, you are putting the business that you are buying on the line. And the owner of the business is getting the cash, he's out, and you have this asset, which you didn't create. So what's the hiccup? The bank has what they want, the owner has what they want, and you have what you want, which is the ownership in the company. So that's how the banks make money. That's why the banks are important, and how the banks, you can use it to accelerate growth, and you can use it to create an alliance. If you know what they want, what they are looking for in a deal, if you can give it, then you have a very powerful financial institution in alliance with you. And once this alliance is created, there's no limit, because you can keep finding assets for them, and you're going to keep borrowing and keep structuring the deal with that asset, not on you personally, but with that asset. And I'm going to talk about this. What do I mean, not personally, with the asset? I'm going to go into all the technicalities of it. I just want you to understand how the whole system of banking works, Because once you understand this instrument, your ability to use it goes up, and your ability to see things changes. And you might start seeing that how things, like how you could just buy things because you could finance it, especially if it's a thing that is producing cash flow. And I would travel in Dubai, and I would be sitting in a cab. I would be looking outside at these massive buildings and at these car showrooms and all of this big gigantic stuff. And I would say to myself, this is way before, is that, wow, you know, I sometimes struggle to find a designer shoes that I can buy at the right price, or a shirt or something. And I struggle to afford that. And here they have, like, they are buying up these buildings, they are buying up these big showrooms. Like, forget about buying a Ferrari, like people buy Ferrari showrooms. Like they set up these big, like, automobile shops, and somebody just goes in and buys it. Like, how does all of this work? Like, do they have cash in the bank and they write a check? Like, how does that work? And when I understood the mystery of banking and how banks can be used in so many different ways, this is just scratching the surface here. There is a whole world opens up where nothing is off limits, because you could use banks to do the transactions if you know how to structure the deal, if you know how to use them ethically, legally, with risk analysis, protecting the risk honestly, and having proper expert advisors guiding you, protecting you, structuring proper agreements, all of that included. But you could use these institutions to really gain access to positions of power, positions of affluence and abundance that were not there before. And that's the possibility that we are going to be talking about in this series. I'll talk to you in the next video, the part 2, and we'll go deeper into each aspect, so that by the end of the series, you have a full clarity, full understanding of how the whole process of financing works. I'll talk to you soon.
So in this video, I'm going to be talking to you about, this is the episode 2, by the way, of the banking series of how to finance an acquisition through a bank and how to create wealth using banks. That's what we are talking about. This is episode 2. If you haven't watched the episode 1, I highly recommend watching the episode 1 and then coming back to episode 2. And if you're new to this channel, hit that subscribe button and let's get started. So in this video, I want to talk to you about the legal structuring of $1 million acquisition financing. What do I mean by that? You know, what I mean is, who is the borrower? We as individuals are recognized by a state or a country as an individual. And you could do, in most countries, you could do business in your name, or you could form a company, and then you can do a business in the name of that company. And the laws, the implications of laws changes from individual to a company, and various companies have different kinds of laws which are favorable for various reasons. So based on your activity, based on the type of financing that you want to get, and based on your intention and outcome that you want, you will decide on what type of company you would form. And typically this is a lawyer that has to advise you on this. And this video is not a substitute to having a lawyer. You need a lawyer. But this video is for you to understand the principles, and then you have to consult the lawyer in your city, in your country, and they will give you a version of this structure, and they will tell you how to do it in your city. But this video is not, I'm not a lawyer, you need to consult a lawyer. I'm only going to be sharing you some principles of how to structure the deal. And again, it's for educational purposes, and this is something that is coming from a discussion that I had with a lawyer that structured a $13 billion bank merger. So he's a very senior lawyer. And I was having a conversation with him, and he asked me, we were looking to raise some money, and he asked me, Prithvi, who is the borrower? And I said, what do you mean by that?
And I said, I don't know. Are you the borrower or is the company the borrower? I said, well, it's the company. Why would it be on my name? And he says, yes, that's what I thought. It should be the company that should be the borrower. And there has to be a distinction between you and the company. Your company is not you. Your company is your company. And the assets are in your personal assets, like your house, car is all in your name. So there is a distinction here. And the financing exists in the company, at the level of the company. So typically when you're doing an acquisition or you're buying a business through bank's money, you will not take the loan in your name. And there are several layers of companies that you would create to diversify your risk or to protect yourself. And I'm going to talk a little bit about that. But fundamentally, and I did not know this, that's the reason I'm sharing this. A lot of you know this. I know that. Is that individual and company is different. The financing can exist in the name of the individual or a company. And if things don't work out, the company can go bankrupt or the individual can go bankrupt. And there are different implications in both these scenarios. If an individual goes bankrupt, that's a little bit more serious than a company goes bankrupt. And this is assuming there is a financial difficulty and not a financial fraud, which is a completely different thing, because I started to watch some big businessmen who got into trouble and then they went to jail, and I didn't understand. I thought that it's because they didn't pay off the debt. No, that's not the reason. It's not that they didn't pay off the debt because of financial difficulties. They went to jail because they lied before getting financing. They misrepresented the financial information to the bank. They lied, they fabricated information, and that is fraud. Okay? So don't do that. You've got to be upfront, honest, disclose everything to the bank. And a lot of the people who get into trouble with the banks, they lie and they cook the books, and that's a fraud. So that's not bankruptcy, that's a fraud. Bankruptcy is when you have financial difficulties and you can not make the payment. That's bankruptcy. And you have been honest, you obtained the money honestly, and it was in the name of the company. So to diversify the risk, you never borrow on personal name, you always borrow in the name of the company. I'll give you an example. There is a company called WeWork, and that company went into bankruptcy, the company itself. And after the company went bankrupt, the founder was still worth $400 million. Now think about that. The company has gone bankrupt and it cannot pay the debt, but the founder has $400 million worth of assets because he says, hey, the company went bankrupt, not me. I'm still rich. And that happens a lot of the times. Another example, Bill Gates is let's say he's a share. I don't know how much of Microsoft he owns right now, but one of the companies is Microsoft. He has another company. If one of them goes bankrupt, doesn't mean he has gone bankrupt. He's still one of the richest men in the world. And it is possible that, I don't know if this has happened, but if it happens or if it has happened that one of the companies he was an investor in or he was involved in went bankrupt, doesn't mean he's bankrupt, because his assets are diversified over many companies. And this is what the rich do. They form separate companies, even for little projects. If they want to buy 10 houses, they will not put all those 10 houses in one company. They will form 10 different companies to buy 10 houses, and each of those companies will have separate financing from the bank, separate loan. And the loan sits on the company's books, not their personal books. There could be houses in their name which will not be affected. So it's a legal maze, so to speak. You're creating a maze, and all of this is legal, and you have to make it legal. Obviously, you have to consult a lawyer to do this. It's a complex structure. Several law firms, I've met over 40 law firms. They have billion-dollar revenues, And they explained to me the structure. Also, I have an in-house lawyer who is a high-profile lawyer, and he explained to me how this thing works. So they will have a holding company at the top, and then they will have separate companies for each acquisition that they do. And all of this is connected with the holding company. And the holding company is just there to hold the shares, hold the ownership. That's it. You don't own the ownership. You own the ownership in the holding company, and the holding company owns everything. And this is all done. It's a complex legal structure. I hope you can follow what I'm saying. But it's a complex legal structure to avoid risk, to avoid financial risk. I'll give you a scenario. Let's say you bought 10 houses, okay? And those 10 houses are in the name of one company, just one company, and it has bought 10 houses. Well, if one of them is struggling and is not able to pay the debt, the bank can actually use other companies to pay off that debt. And your whole portfolio is affected because you've cross-collateralized. Now the 10 houses are all mixed up with each other. And if one is bad, and sometimes it happens, then everything is a mess. Everything can be leveraged to pay off that, to cover up that one, to cover up the mess of the one. So what the super big mammoth companies, what they do is, they don't buy 10 houses with one company, they buy each house with separate company. And each of them will have separate financing. And now you have protection. If one of them, let's say house number 10 goes bad and cannot pay the loan, the tenant disappeared, whatever happened, and you can't find a tenant, the location is not good, whatever the reason is, you could just list that company into bankruptcy, but you still got 9 more. And they are untouched. Assuming there was no personal guarantee. Because the company is the borrower. And it's in the name of the company. But if you sign a personal guarantee, then your personal assets are also on the line, which is something that a lot of the people don't recommend, but sometimes the entrepreneur believes in the project and he signs his name as a personal guarantee. And then all the assets that you have all around the world is under, the banks can use to get their money back. Or you could be as smart as this guy from WeWork. I don't know the entire details, but all I know is WeWork went bankrupt and he's still rich. So he did a lot of legal protection, and that's what the big lawyers can do. So this is to understand the legal structuring, and there are ways to protect yourself in a bad scenario, and that's why you need a lawyer. You need a financial advisor who have done this many times. And I got exposed to this, that there are people, the super rich, who do business and they protect themselves from risk properly. And there are scenarios where there is little or no personal risk to yourself in a financing, because you have identified them and addressed them and protected yourself. Not 100%, but there is a significant amount of protection that you can get that I did not know that you could get. So I was exposed to only personal loans, when you buy a car or a house, and all kinds of scenarios can happen there through a bank. But I did not have the exposure of this complexity of legal structuring around financing, which is extremely sophisticated, and it can completely diversify your risk and protect you from a lot of trouble. So I thought that before we get into how to structure the financing and the deal itself or any scenario, I create this sort of concept for you that this is available in the market for you to structure this and for you to act, and you structure things in a sophisticated manner that protects your risk. And the lawyers help you do it. That's the reason I was advised, you get the top lawyers, top accounting firms, top financial firms, and they have done this many, 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 many times. And it's not that the rich are always the smartest, but they have the smartest advisors, and they help them structure this. Now, of course, the bank, if the deal is not good enough, can get you to sign a personal guarantee, and then, you're on the hook. But there are ways to separate that and to do business in a smart manner. So I want to talk, this is the video I wanted to talk to you about legal structuring. And I wanted to create a distinction between personal loan and a company loan, and also that you can form various holding companies and you can separate the financing to buy each company. And all of them is connected with one holding company, and there is a structure whereby the ultimate owner of the company is actually offshore, where you form a company offshore, away from the jurisdiction, and that company owns the holding company. And that holding company owns another holding company, which is separate, and that holding company owns the clinic or real estate or any asset. So it's a very complex structure, all interconnected to offshore, onshore, and you're engaging multiple jurisdictions and you're creating a complexity. But it's all done to protect yourself from risk. All the implications of this, why it's done, what are the benefits, you could talk to a lawyer. Any good lawyer is going to tell you how to do this. A corporate lawyer, M&A lawyer, which is what I have, and they tell you how to do this, and the law firms tell you how to do this. So I just wanted to share with you that there are ways to get money from a bank, borrow money from a bank to do business, and to structure it in a sophisticated manner. And that's today's video on the episode 2. Wait for the episode 3. And by the way, I have opened up the group mentorship program, which I will be conducting in the next couple of months. And I'm in the structuring period, but if you want to join the waiting list, if you want to sign up, if you want to inquire about it, the price point is slightly lower compared to the one-on-one, because one-on-one takes a lot of my personal time, one-on-one. But in group, you have, a group of people, and it's going to be an engaging session where many questions get addressed from many perspectives. And it's going to be a group session. It's going to be priced a little bit less than the one-on-one. It's going to take place over 6 to 12 months. I'm still yet to announce the date. But if you want to sign up for that, if you want to join the waiting list, click the link below, message me on Instagram, LinkedIn, email me, or message me on Facebook, whichever platform you're comfortable with, and let's have a conversation. I'll most likely give you a form to fill if you haven't filled it already, so that I understand your situation fully. And then from there, we can move into a Zoom call to dig further what you want to do, what your goals are, and how you want me to help, and if the group consultation is for you or not. And if you still want to do one-on-one, you could reach out to me for that also. The seats in the one-on-one are limited. The group I'm opening up right now. So if you're interested, reach out to me and we'll talk soon.
So in this video, I'm going to be talking to you about, I'm going to be revealing how do you navigate the maze of banking. And I will explain what I mean by a maze, because banking is a maze. And one of the challenges that you would face is going to be how to find the right banker at the right level who can give you the money to finance a deal, loan you the money to finance a deal. And just to give you a perspective, I have met over 80 plus bankers in 26 banks, and I have reached out to thousands of bankers. Okay, and I've spoken to the cream of 80 bankers in various divisions of the bank. I have met HSBC, Citibank, Credit Suisse, Barclays, all of the major global banks that have offices in UAE. I've also met a Chinese bank that is a very big bank that's based in UAE, and I have met all of the local banks in the UAE. And one of the largest banks has 30,000 employees, 30,000, and most of them call themselves bankers. So when you say I was just on the call with a banker, you're talking about someone who is among these 30,000 people. And how do you navigate who the right decision maker is out of these 30,000 people? It's kind of like a stadium full of people. That's how big a banking infrastructure is. And to find the right division, the right banker in that division at the right seniority level, who has a signing authority or who has the power to make a decision or make something happen towards financing your business, is absolutely and crucially important. The business case itself becomes a secondary issue. I'm making a very bold statement here, because if you're not talking at the right level of the bank, even if the business is good, you may get rejected because you're not speaking with the right banker or right level of bank, a bank who can attend to your request and your proposal in a favorable manner. Okay? And UAE is a very small region, and still it has got 30,000 people within one bank. So that's what this whole series is going to be about. It's going to absolutely blow your mind and change the way you look at banking forever. So stick till the end, and your mind will just get blown away by how complex this is, and hopefully I can clear up a lot of the complexity of dealing with banks. By the way, this is an episode 3 of a multi-part series. So if you haven't watched episode 1 and 2, I highly recommend watching it. Otherwise, this episode is not going to make any sense. So this is a multi-part series. This is episode 3. We'll call it the maze of banking, or decoding or exposing the maze of banking. And also I have a big announcement to make. That is, I have opened up the group mentorship program that will take place over 6 to 12 months. The registrations are open. If you're interested in learning how to buy multi-million-dollar businesses which are in your city, and use banks' money to buy a business and take a major ownership in a multi-million-dollar business and buy several multi-million-dollar businesses. If you want to understand the process step by step, I am structuring a mentorship program. I was offering one-on-one. Now I'm offering group, which is going to take place over 6 to 12 months, and it is priced less than the one-on-one. So if you could not afford the one-on-one, you could sign up for the group. If you're interested, message me and we will get on a free consultation call, and we will discuss if this is the right opportunity for you. We'll look into your situation. Most likely you would be meeting me one-on-one, and we will look into your situation and see if it's a right fit and move forward to signing you up for this program. If you're serious, if you're interested in learning how to acquire multi-million-dollar businesses, if you want to be in a position to do that. So let me know. Let's get right into it. The maze of banking. So you got 30,000 employees in one of the largest banks in UAE, and how do you find the right banker? Okay. So I'm going to share with you various divisions of a bank. And if you understand the divisions, and if you understand how many segments there are, then you can navigate it very, very effectively. So I have found there to be around 5 divisions, and each bank has different policies, and each bank is structured in a different way internally. The way they operate. Just like every company operates in a different way, they have different divisions. Just like that, each bank is kind of like separate, but each bank has a version of this structure that I'm sharing with you. The divisions may be called something else, but most of the banks have this structure, and they have different names for this structure. But ultimately, it's divided into these structures which I'm going to share with you. So let's divide the bank into 2 segments: personal loan and business loan. Okay? And I'll talk about the business in a second. The personal loan is what most people go to. And also within these 2 segments, there is a front side and a back side. Let's call it that. Okay? So one area of banking is depositing money, where you give them the money. Okay? That is depositing. And this is the banking I was exposed to since childhood. My mother would tell me, go to a bank, which would really mean a bank where you deposit money. That's where most people go. Then there is the lending side, where you go asking for money and they need something in return. Okay, that's lending. There is personal lending and there is business lending. Let's talk about personal. Most people go for a personal loan, whether they want to buy a house, education loan, car loan, gold loan, a small loan for a purpose backed by gold or silver or whatever. All of that comes under personal loan. When we talk about achieving hyper growth through acquisitions, you're not dealing with this kind of financing. So most people have banking relationships in this area. And in fact, a very large portion of the bank is structured around catering to this audience, because that's where most people go. And this is the banking most people are familiar with. They're depositing money and asking for small loans. And by small, I mean a couple of 100,000 is a small, very, very small for a bank. You got to look at it from the banking perspective. So that's the personal side of the equation, and this is where most people go. And this is not the side that you go when you want to buy $1 million company or a $10 million company or a $100 million company. Okay, and most of these 30,000 employees will be to cater this. By the way, your credit card also falls under this, and this is known as retail banking, small amounts. Okay, leave that aside. Let's go to business. Within business, you have got small to medium sized enterprises. Okay, small businesses basically. Then you've got medium sized businesses. In some banks, these are known as commercial loans. Okay, commercial banking. And then you've got corporate banking. And then you've got the large corporate and investment banking. And you also have wholesale banking. Okay, so you've got 5-6 divisions. And each bank has a version of these divisions. Okay, and I'm going to talk a little more about these divisions and what's each of their purpose, etc. In some banks, this is known as small corporate, mid corporate, and large corporate, and mega corporate. Okay, so these are just names that each bank can have separately. All right, but in some banks, I've noticed they call it SME, small to medium sized enterprises, mid corporate, large corporate. In some banks I have seen they call it small corporate, medium corporate, large corporate. It doesn't matter the name, but the idea and the principle is that these divisions are divided by the size of the ticket. Whatever amount of money you want to borrow, based on the size, the bank refers you to that particular division. Okay. So one criteria is the size. The second is the type of loan. Okay, let's look into this a little more deeply. Okay, we're going deep into rabbit hole. Pay attention. I don't want to lose you. Pay attention and see. So the type of loan, there are two types of loans in business. One is asset based. So when the bank gives you money, it wants something, right? Most of us are familiar with real estate loans, where they give you money and you give up the house or something, right? So that's a real estate loan. You give house as a collateral, or something physical as a collateral, which is typically an asset. That's known as financing. You're getting money in exchange for an asset. That is asset-based funding. Another type of funding is cash flow based, where they want access to cash flows. So your credit cards, you don't give any physical object to get a credit card, right? They usually look at your salary. They have access to how much you make every month, and based on that, they decide what your credit limit is, and they give you a credit line, right? That's a credit card. So that is cash flow based, and this is asset based. When we go looking for acquisition financing to buy a business, in most cases, we are not looking for asset based. We're not looking to give physical object. We're looking for cash flow based, because the strength of a business, a service business like healthcare, it's really cash flow, because most of these companies don't have real estate involved. They have a couple of doctors, and they're working and they're producing money, like they're producing liquid cash. So some of the banks and some of the divisions within the bank deal with asset-based lending, and some of them deal with cash flow-based lending. Okay, so now you have a further lens to navigate the situation. Some banks favor assets. They want to gobble up assets, take people's houses, and some banks like cash flow. They want to put their hooks in the cash flow and get access to that. Okay, so these are two types of loans: asset-based and cash flow-based. Okay, and these are divisions, and these divisions are divided by ticket sizes. So small to medium, I would say, would be $1 to $5 million, $1 to $7 million, $1 to $9 million. Bank to bank, it's different. Medium would be 10 to 20, 10 to 30 type, and large would be, it's not really large, but it would be anywhere between $50 to $100 million or beyond. And then you've got the investment bank, something like Goldman Sachs, which deal with investment banking. If you want to make an investment, you're taking a loan to make an investment. There are sophisticated investors that use debt to make investments along with their own money, and they acquire large chunks of large businesses. And this investment banking deals with a lot of things. They also take companies public. So you've got the Goldman Sachs, JP Morgan, almost every large bank has an investment banking division. This is probably the most sophisticated divisions within a bank. You've got high profile bankers. I mean, you've got, they look like Gordon Gekko from Wall Street. I mean, they're wearing like pinstripe shirts and, cufflinks and all kinds of shit. I've met them in Barclays, Citibank, not Citibank, in Barclays and Credit Suisse. I met their investment banking division, because that's the offices in UAE. They have the investment banking, and the minimum ticket starts at $50 million, and they call it, that's a small deal for us. They want a deal where they can generate advisory fees of a couple of $100,000 just to offer advice on the transaction. That's investment banking. That's the sexy part of the bank. Anyway, so we'll talk about the SME, mid and large. So typically you will deal with SME or commercial or mid corporate. This is anywhere between 1 to 10 million and 10 to 20 million, 10 to 30 million. And this is where you will narrow down if you want funding. Now, in your region, in your city, in your state, these may be called differently, but these are structured around sizes. So in this division, you will have junior bankers. And in this division, you'll have a little bit of a senior banker who has worked in the bank 10, 15, 20 years, right? And in the investment banking, you'll have the most qualified, high performers. The Ivy League guys are going to be here, like the top tier bankers, very sophisticated. They are positioned, and based on the quality of a banker, the bank decides who gets to be in what division. Okay, and each of these divisions have heads. Each of these divisions may have a separate credit committee, or they may have a common credit committee. And this gets even more complex. That's why it's known as a maze of banking. I'm calling it a maze of banking for a reason. And city to city, each bank branch may have all of these functions in every city. So a place like India or UAE, Dubai may have an office. Let's say UAE, Dubai may have an office, Abu Dhabi may have an office, and all of these offices have all of these divisions, and all of them are separate bankers. That's one possible structure. Another structure is everything is interconnected and all the 5 divisions are in one place. That also happens. But this is a complex. Just to find the right division and the right bank is a task. That's what I'm really trying to communicate here. But if you do a lot of calls, you can find the right banker, you can interview several bankers. And I've sat down with bankers on the phone understanding all of this. There are ex-bankers who left the bank who told me how it's structured from inside. And the decision makers within these divisions keep changing. So not only it's a maze, it keeps moving. The power keeps moving. The members of the credit committee who take the decision on the loans, they keep changing. The bankers keep switching banks, they keep changing. And everything is dynamic and moving. So that's why when you call a banker, he says, we can't finance your deal because we are an asset-based lender. Second time you call, that bank's policies have changed. Now they are cash flow based. Because all of this is interlinked with the economy. I mean, you can really feel that you're in the eye of a hurricane. Because everything that happens in a country, the first type of institution to take a hit is a bank. And they have to be on top of everything. They have to keep changing their policies, they have to keep changing their people, they have to keep restructuring. And they have to make loans fast and they have to make it efficient, and it's a very complex structure. And a lot of the people say, finding a deal is the hardest thing. I would say navigating through the banks at the right level is probably the hardest thing. And we're just beginning to scratch the surface, by the way. Now we have identified the divisions within the bank. We know where to go. We know asset-based, cash flow-based. You have some of the banks who are very large in size have further divisions. So it may have a real estate division where a banker who has knowledge about real estate, only he is looking at the deals of real estate. And you have many bankers like this who are only trained to look at real estate deals. And that's a real estate division of the bank. So if you call them up, you set up a meeting, you have to say, I want a real estate loan for business purposes. They guide you to the real estate division. You've got petrochemicals, oil and gas. That's a separate division of the bank. You've got, some of the banks have healthcare division. Well, there is a reason why they have these industries. They're very profitable and a lot of activity goes on in these industries. So they have set up separate divisions where you have people who are specialized to look at these deals. You have experts in these industries. And so they are trained to look at these deals and assess whether it's a valuable opportunity or not. So you got to make sure that you deal with the right level of people, because sometimes the banker doesn't know that this is not something that I can look at, and he doesn't guide you at the right level. And he may just say, we don't do this. I have had where I approached a bank with a deal and I say, I want acquisition financing. And he says, we don't do that. Our bank doesn't do it. That's what he said. But what he meant was that my division doesn't do it. There is another division who does it. But of course, that other division is in a different part of the town that he hasn't been to. It's in a different office, because remember, it's 30,000 people working. And this person said, no, our whole bank doesn't do it. And when I speak to another banker in the same bank, who's from a more senior division, he says, we do that. So a banker said no to you, and you may think, oh, it's a no. The whole bank has said no. But just to put things in perspective, you've got 30,000 people in this thing. You've got multiple divisions. And these divisions, they're so busy on their own, they don't meet each other often. Sometimes they have a marathon or a big event where everybody comes together. But, typically, everybody's separate. Not everybody, but these divisions are separate, in separate locations. Some of them are in separate buildings. Some of them are in separate floors. You get the point. So, and there are people who don't know each other, even within the bank. There are types of lending that happens, that the bank does, the types of services the bank gives, that the bankers themselves do not know. The junior bankers, the seniors know. And then finally you've got the wholesale banking, where where one bank lends to the other bank, or bank borrows from government, and those are very big divisions. We don't go to them. Those are usually 500 million, 700 million, billion-dollar loans. That's wholesale banking. Okay, it's also known as institutional banking. So this is the lending side, personal versus business. I'm just summarizing. Personal versus business. Within business, you've got small, medium, large, and investment banking. All of them are divided up with different ticket sizes. And you've got asset-based, which is physical asset, and then you've got cash flow-based lending. And then you've got also industry-specific divisions. That's just the division. Let's talk about the banker itself. So there are, in each division, you've got seniority of a banker. Some of them will be members of the credit committee. Some of them will not be the members of the credit committee. Okay, some of them will just take your case, prepare a presentation and present it to the credit committee. Okay. And so you've got people who are known as relationship managers. A lot of the banks, they're known as relationship managers. Then you've got senior relationship manager, you've got vice president, you've got senior vice president, and you've got head of the department, corporate. And you have to understand how many of these are involved in the decision-making process, and can you get everybody on the phone or on the call to present your deal. And the more the senior, the better. Because, and if he's the one who's involved in the decision-making process, then it's easier. And you may not understand what their decision-making process is, because they may say it's the credit committee who decides, but the credit committee may have 2 or 3 people. Sometimes they come on the call, sometimes they don't come on the call. They send a junior banker to understand the case and present it, and they keep a distance between the client and the decision maker, so that there is no funky influence that can happen. And sometimes they don't tell you who is the one who's going to take the decision. You're one representative of the bank who understands the case, and this person may be qualified, may not be qualified to look at acquisition financing. So there are a series of complications, and this banker has to understand the case, sort out the information, and then present it in the right manner to the credit committee. And then the credit committee either approves or rejects the proposal. Sometimes the powerful members of the credit committee, you don't know that you may be dealing with them, are the decision makers. And you're dealing with a senior banker who can actually has influence with the credit committee, and he can get the job done. Once again, every single bank internally is structured differently. Their decision-making structure also changes, and the people in power also changes. So it's a moving target, and you have to inquire, investigate, talk to a lot of bankers to understand what their system is like, and then you got to penetrate. Once you find a banker, once you have the financing, once he has moved his ass and actually delivered some result, then you know he's a legitimate banker. And then you can put that particular banker in your cream funnel, where all the cream contacts are. And once you build a relationship at the right level, once you finance it, then you know who to talk to and what the process is like. But one of the superstars in the communities that I'm connected with, he spoke to around 200 bankers, and he met physically. And he understood all of this. And I met over 80 plus bankers, because in UAE you have only 26 banks. So I spoke to the 80 top highest level bankers and understood what the process is like. And this is the information that I got. I'm sharing it with you just to have an idea what the process of fundraising with a bank is like this is when you find a deal. So this is why it's important that before you find the deal, you do this process and you penetrate the banks in the right manner and get connection at the right level and understand where to talk to. And again, we haven't yet talked about how to present the business case, what are the financial metrics, the deal itself. We haven't looked at that. This is just establishing contact with these guys. That's how complex and intricate this is. And it's a good thing because you know most people are not going to go through this and they'll give up. And people who manage to get at those levels, at top levels of banking and manage to make connections there, gain tremendous amounts of power and leverage and access. And most people don't even get to even go to SME or mid corporate or large corporate. Forget about investment banking. Very few people. The higher the echelon of the division and the higher the echelon of the bank, the fewer people have gone in those rooms and fewer people have made contact. And by the way, the divisions of the bank becomes smaller and smaller as the ticket size increases, because fewer and fewer people get more and more qualified and the power becomes, extremely concentrated at the big levels. And I have met several bankers at that level. I've met a banker whose minimum ticket size he would finance would be $100 million. And I asked him, I said I had a deal, $3.5 million. I said, this is a deal, what can you do? And he says, we do acquisition financing, but this is very small. I said, what would be your ideal ticket size? He hesitated, gave me a pause, looked in my eyes and said, $100 million. We can talk about it. And I was like, oopsie doopsie. And I was like, oh. So I made a contact with someone that can finance a big target and is looking and is interested and came on the call with me and spent 30, 40 minutes with me and will talk to me, and I have his personal number. I just have to find a deal of that size and work on it and present it in the right manner, and wow, things open up speaking to bankers that you didn't think were possible. I went into looking for 3.5 million and this guy is saying, we've got more. Do you have a deal of that size? A good deal? Maybe we can look at it. We are open to looking at it. And that's the power and that's the magic of dealing with the banks and going through this process. Is you discover things that most people can only dream about. You make connections that most people don't have, and it's because you made the phone call, and it's because you went through this process. And most people don't want to do this process. Most people don't want to deal with debt. Okay, let me start again. Most people don't want to get into business. They get into business, they want to open a restaurant, small restaurant. They don't want to do a big business. Then few people want to do big business. And then fewer people want to deal with debt. And even a fewer people will go through this process and even understand and comprehend this process. So if you look at, as I was mentioning in one of the videos, the bigger the risk and the more complexity, the less the competition. Because most people don't understand this and then they don't put themselves through this, and they will never get to these top tier bankers who can make things happen. And that's today's video, decoding the maze of banking, and I'll talk to you soon. So welcome to episode 4 of the banking series, and in this episode we are going to be talking about understanding what exactly do the banks want. And if we understand what they want upfront, then when we go to find an asset that we want to buy, we can keep that understanding in mind and we can structure the deal based on their preferences. And if you're just watching this series from the middle, what I'm saying is not going to make sense. So this is a multi-part series on how to create wealth using banks. So if you haven't watched the first, second and third episode, this episode would not make sense. So if you haven't watched that, I recommend please go and watch those videos first so that you have the full perspective, full picture, and you have a complete understanding of this concept. Let's get started. So it's important to understand what the banks want from us or from a transaction. And when I first reached out to the banks, I was extremely nervous because these are some of the top bankers. I had very little experience. I had some very powerful people in the whole region as my business partners. I still have them. And, I was extremely nervous as to the types of questions they would ask me. And I was, trying to prepare all kinds of answers from my personal life. Things like my background, things like which college I went to, which university I went to. And I really thought in my mind, this is going to be like a job interview. But actually, the banker doesn't care about any of that. The banker doesn't care whether you went to an Oxford University, Harvard, what degree or qualification you have. In fact, I haven't been asked by even a single banker, what degree did I do? As strange as that sounds. Because they don't offer money on that basis. The degree is not going to give them their money back. And what you did 10 years ago, 5 years ago, 15 years ago, they don't give a shit. So when it comes to lending money to you, the bank is not looking at you, the bank is looking at your company and or the company that you want to buy, and the team and the experience of the team as a whole, not just your personal experience. And this is the reason I made one of the videos why qualification and experience is not a mandatory requirement, because you can always find people who are qualified and you can always find people who are experienced on your team. Because when you go for funding, the person lending you the money or giving you the money or investing the money looks at the whole team, that the banks are giving the loan to the company, not to you personally. So it doesn't matter if you didn't have that, Harvard degree or whatever the nonsense that they sold us in school, that if you don't have a degree, you're not going to be successful. That's just not true. In the real world, things are decided based on income statement and balance sheet. So that's a different report card. We'll talk about that. But the bank is interested in understanding who your company is and what deal do you have on the table and how are they going to make money, and what is the bonus the banker is going to make, how much money the bank is going to make, and what is the risk they are taking when they give you this financing and how they can limit the risk. They are pretty much interested in this. And they are also interested in assessing risk of the industry that they are lending in. So it's really not a personal conversation where it is about you, and there is no place for there is no rationality to have insecurities, to go into a meeting with your personal insecurities. What do they think about me? What do they think about my background? And how do they assess my experience? All of that doesn't matter in a conversation with a banker. The banker wants as much collateral / cash flow as possible and give out as little loan as possible. And I want to take as little risk as possible and want to make interest. That's what banking is about. It's about making money, making interest, making fees, and reducing the risk. That's what it is about. So it's really not a personal discussion. So if a banker says no to you, they're not saying no to you, they're just saying no to the deal and the way it's structured. And you can bring another deal and they will have a different response. So when they say no to you, I know it sounds very simple, but when they say, I heard a lot of no's, and then I started to make it personal, maybe it's about me and my look and my experience and all of that, and it's none of that. It's just the acquisition. And you can bring any other deal and he's going to look at it with just as much enthusiasm, because he doesn't care. Okay. So he wants to see the target that you want to bring. Okay. So when we go to meet them, we don't meet them first time with a deal on the table. It's too soon and we don't understand what they want. So to assume what they want and structure the deal based on an assumption, it's not going to be right. And there are many reasons why you first talk to the banks before you look for the deal, because you want to understand, first of all, who the decision maker is, what is the level of banker, what's their decision making process looks like, what are their lending criterias, and you want as much information as possible so that you can feel a little bit grounded as to your understanding about what they want. So then you can later on negotiate with the seller accordingly. So couple of housekeeping points. When you go to see a banker, you got to dress up in a 3-piece suit with a nice tie, a pocket square. If you have cufflinks, you can wear cufflinks. It just gives an added authority to who you are. And not only about your look, but the venue that you choose to meet the banker has to be pristine. Everything has to showcase success. And it's a very subtle thing, but when the banker meets you, the whole backdrop of the situation, how you look, how you're dressed up, you're making a statement about yourself. You know, you're conveying that you're someone who is serious about success and who is someone who is successful. And you're already living in that future and you have every intention to be super successful. And it's conveyed based on the venue that you choose, based on the clothes that you wear and all of this. At least that's how it's perceived. So it's important how you come across to people. You know, you cannot have a ponytail, you can't have a t-shirt, I'm sorry guys, you can't have a jeans. This is not a picnic, as my chairman would say. You know, this is a real serious business conversation and you're asking for their money. And I remember my mentor told me, you got to look like they should be asking you for money. That's how you should look like. So that's the get up. And you should also observe how the banker is dressed up. You know, I've seen some pretty, very well dressed bankers, and they tend to be dealing with very high tickets. So they'll have a cuffling, a nice silk tie, a 3-piece suit. They'll be sitting in a nice luxurious office, and that's a top tier banker. That's how he looks like. But most of the bankers don't look that pristine, but the bigger ones do. So look at the clothes and you would assess what the seniority of the person is. Okay, and also observe the voice and their stature in general. If they're too imposing and dominant, you're talking to, most likely you're talking to a decision maker. And if you just make contact at the right level with the right banker of the right seniority, you have you've taken a significant step in understanding what they would want. Because this person who is in a position of power can give you the most accurate picture. Not only that, you have a point of contact with someone who can make something happen. If you speak to someone junior, you're all the time mediating through someone. You're all the time communicating your message, your business proposal through another person. And there is always that Chinese whisper effect if you speak to someone junior, because they may not have the technical understanding of what the transaction is. They may understand something and they may communicate something else. It happens all the time that they misunderstand the information on email, they misunderstand the information that you said to them on the phone, and then they miscommunicate with the senior and they come back with an inaccurate response. Happens all the time, especially in banking, because banking, there are many gatekeepers. When you go to talk to a business that you want to buy, there is maybe 1 or 2 gatekeepers. But in banks, sometimes there are many gatekeepers. So you got to make sure that you deal at the right level with the right banker that has got power to do something. And you got to qualify them, you got to ask them these questions before you move forward with your proposal. So now you've found the banker, you're sitting with him, you're at a nice venue, and ideally you should have a couple of your directors there just to create that sense of power and seriousness, and these directors, it's good if they have some gray hair. And if you don't know how to get your advisors and directors, message me. I have a mentorship program on teaching you how to do that. But you need to have your directors and advisors with you with gray hair, and you are showcasing experience and success, and then you can start the presentation. So first level of presentation is going to be high level. You are making a contact for the first time, and you want to make a statement that this is not a one-time lending. Okay, people who take personal loans to buy a house or car tend to be one-time thing. They're not going to keep on getting financing from a bank to buy these personal items. It's just a one-off thing. Somebody wants to buy a car or a house, you meet your banker a few times and it's done. But in a business transaction context, especially when you are going to be buying many companies, and especially the very big companies, banking is almost like a very regular thing, and getting financing is almost like a very regular thing. So the context of the meeting is not to get loan one time. The context of meeting is over a long period of time. You're looking to make a relationship with the banker because you're going to be in business and you're going to need financing, and you are someone who's working on not just one, two, but many big projects, many deals, and you would be doing many deals in the future. So that's what you have to communicate, and you should have the intention to do that. And then the whole conversation is not about one deal. The whole conversation is about a larger vision of a relationship that you and the banker can have. And you got to communicate that you understand what his limitations are, and in what circumstances he can finance and what circumstances he cannot finance. And you have to understand how to structure the deal in the bank's favor so that the risk for the banks get reduced and you have rich cash flows so that it's favorable for the bank to give you the money, to lend you the money. And if you can communicate that you understand their position and you're going to structure the deal based on their preferences, and you're going to only bring deals that they can finance, meaning you're only acquiring profitable businesses. We are not in the business of acquiring loss-making businesses and turning them around. We are in the business of buying established, profitable businesses that have been profitable since the last 5-10 years. So it has got an established cash flows, it's an established reputation. It's a 17-year-old business or 15-year-old business. It's very well established in the market, and you would have given the money anyway to that business. And those are the types of businesses we are looking at. So you got to give that impression, and it has to be real. It's not just about giving impressions here. It has to be real, is that you're looking for a long-term relationship and you would be doing several deals. And when you communicate that effectively and they see that you have these advisors and you have a serious intention of doing many deals, he sees you as a long-term partner, and he sees his bonuses coming from you. He sees his compensation coming from you. And he'd rather have one good client that keeps on bringing more and more business to him versus all the time looking for new clients. He would prefer one client and you have an understanding with each other, and boom, you make a phone call and you give the information. You have an understanding of what the banker needs from you, and you have a process in place. So that has to be at the back of your mind, that this is not just a one-time conversation. This is towards a long-time vision for the future. So to do that, you got to present the vision of your company. What is it that you intend to do? How big do you want the company to be? And what would be the role of the banks? And what are the types of assets that you would be acquiring? What industry you would be getting into? And why you're getting in that industry? And have a high-level presentation, brainstorming session where the banker asks you a question. Okay, what's the rationale behind this, behind that? And it's a very high-level discussion. You're not talking about numbers in this meeting. This is just an introduction where you create the vision for them, what you're planning to do, and how important banks are for that vision, and how you're going to finance many deals, and how in this industry there are plenty of deals available from which the banks can make money. And that's what you're communicating. So you're all the time speaking from their interest. You know, banks don't give you money because you need it. They don't care about your need, they don't care about your dreams. What they care about is making interest, fees, and getting their principal back and reducing risk. And the banker is interested in making a bonus. So the presentation is structured to communicate that your company, through your company, they are going to be accomplished that goal, and you have plenty of advisors to validate and structure the transaction in a way that they make money. And you make money, of course, but it's really, when you communicate to them, you got to speak from their interest. And your interest is really aligned here. So the intention is to introduce yourself, one, and second is understanding what their lending criteria is. And you got to tell them up front, listen, we are going to be looking at acquisition candidates. We are going to be looking at multi-million-dollar deals. But before we did that, we wanted to establish contact. We wanted to share the vision, set up an introduction towards a long-term partnership. We are looking for long-term strategic financial partners. And we wanted to share this vision with you, and we want to also understand what are the deal terms, or what are the structure of a deal that's favorable to you? What are the financial ratios that are favorable to you? So you need to understand, and do you lend in our sector, our industry that we are getting into? Do you lend in that industry? You would be surprised, a lot of the banks have banned certain industries. They don't invest in those industries. They don't make any loans in that industry, or maybe on a very exceptional basis, but generally they don't make loans on certain industries. They have like a ban on them. Maybe they had a bad experience with them and they don't want to make any loan in that industry. So you got to know that up front, whether the industry you are going into, is it banned in that bank or not. I remember there was one bank, it was an Islamic bank, and they said, we don't finance cosmetic clinics. I said, why not? And they said, because it's against our culture and tradition, or all of that. So it was a very culturally sensitive bank, so they don't finance cosmetic clinics. So I'm not going to present a cosmetic clinic to that bank. So I have that information. So first level of assessment is going to be at the level of industry. Then it's going to be on the business model, which is buying businesses. You would have communicated that. And then the next would be the type of company, the deal size. So you could ask, okay, what's the deal size that you can finance? What do I got to do to finance a $1 million deal, $5 million deal, $10 million deal, $20 million deal, $50 million deal? Which department do I have to go to for each of these levels? What is the decision-making process for each of these levels? And how is the decision taken in your bank? So what you're really doing is you're qualifying them, because you want to understand how their internal process works, so that you can expect, you can expect how much time you would be spending and what would be the procedure like to go through them to get funding. And you can factor in the time it would take to get funding. And you can also ask them, how much time does it take if we start a discussion for us to conclude? What are the documents you would need? And what are the financial ratios? How much cash flow do you need? What are the profit margins of the business that you want? Operationally, is there anything specific that you don't like? Or is there something specific you do like? What type of transaction sizes do you like? So for example, I went to a banker and I asked him, your department, how much financing can you give? He said, we can do between $1 to $10 million. And I said, okay, so which one do you prefer, 1 or 10 million? He says the approval process for a $1 million loan and a $10 million loan is exactly the same. It goes to the same department, the same credit committee, it's the same documents and everything. So I was like, wow. And he said, we would rather you do a $10 million deal than a $1 million deal. I said, why is that? Isn't $10 million, you're giving more money out? Does that mean you're taking more risk? And he said, no. The $10 million deal is actually less risky than a $1 million deal, because a $1 million business is dependent on few people, and a $10 million business is well spread out, and it has a more powerful infrastructure. It has a very strong reputation, and that's the reason that business has become that big. So larger businesses tend to be more stable, and we prefer larger businesses versus smaller businesses. That's what he told me. But the real truth is, what I know, is that their bonuses are linked with the transaction size. So the bigger you do the deal, the bigger the bonus. And it takes the same amount of time to do a $1 million deal versus $10 million deal, and they make more money in the same amount of time if they finance a $10 million deal. So really, they have an incentive to do a bigger deal. You know, when we were children and we would go to our parents asking for money, the more you ask, the harder it is to get the money. But with the banks, it's opposite. The bigger the transaction size, the more interest they have to finance it, because they make money by lending money. So, you know, they get their bonuses based on the transaction size, and it's very favorable. So the bigger the deal, the more they are interested and the more enthusiastic they are, and your deal tends to take priority if it's a big transaction. So if a banker has $1 million deal or a $10 million deal, he's most likely going to pay more attention to this one and try to push this one forward, because A, it tends to have low risk, B, it tends to have high bonuses and high interest. Not high interest in terms of percentage, but larger amount of interest that the bank makes. So they like big deals. So what type of transaction sizes they like, what type of deal structures that they like, how do they want the deal to be structured, and you ask them a series of questions to basically understand their lending criteria. And you may not be taking notes, but somebody's got to take some notes, or you got to remember it mentally, and after the meeting you got to write it down in your phone, and then you create an Excel sheet. And you do this with several banks, you do this with several bankers, hundreds of banks, and you understand their lending criteria, you understand the decision-making process, the time frame, the documents they need, what their motivations are, who the banker is. They know your vision, they know your mission, they know that you're in the long-term partnership, and they know that you would be bringing in many deals to them. So the sooner they finance your deal, the sooner you can bring them another deal, and you can gain momentum. So they have an incentive to empower you. So you've established all of that. So now you have a friend, you have a banker that you know in a bank, in the right division, at the right level of power. And all you got to do is just repeat it 100 times, and you have 100 bankers, and then you go start to find a business. And when you find a business, looking at the business, which bank would be interested, because you've already met them, you have a point of contact, you can make a phone call. Hey, listen, so-and-so, Adam, you remember me, we spoke a couple of months ago about the healthcare project. Yes, I have a business that we have structured a deal. We can present this to you, and let me know what you can do. Oh, sure, send me the note on the email, I'll check it out. And then you do a follow-up and another follow-up, and you keep calling him until he opens that file, reviews it, and gives you his feedback, and then presents the deal to the credit committee and get you a term sheet or an offer. So that's the whole process of understanding their lending criteria and understanding what exactly do they want. And it's not your degrees, it's not your qualification, it's not your personal life. He's interested in the transaction. He's interested in pushing the money out so he can make bonus, and he wants to reduce the risk. So you got to identify the risk in the deal, remove it, structure it. And you do that with your financial advisors, legal advisors, industry experts. And if you want to learn how to find these advisors, how to choose an industry to buy a multi-million-dollar business, and if you want to be mentored by me, I have a one-on-one mentorship program and a group mentorship program. And you can reach out to me to inquire about that on the links below. You could message me on Instagram, Facebook, LinkedIn, Gmail, and I will respond to you. And I will give you a form where I receive some information about you, who you are, and how you make your money, how much time you have available in the day to execute this. And then we schedule a free consultation call. I do one call with you for free, and we go a little bit deeper into what you want and see if this is the right fit for you. If it's right fit for you, you could learn how to acquire multi-million-dollar businesses using banks' money. And if you're interested in that, reach out to me and we will talk soon. I hope you enjoyed the video, and I hope you enjoying the process and getting the feel for what it's like to deal with bankers and what are the principles that govern the relationship. I'll talk to you soon.
So in this video, what I want to talk to you about is what is a personal guarantee when it comes to bank financing. And this is the episode 5 of the How to Use Banks to Build Wealth series. So if you haven't watched the first 4 parts of this series, I highly recommend doing it. Otherwise, this video is not going to make sense. Let's get started. So what is a personal guarantee? So personal guarantee is something that the banks can actually push you in the corner for if you want to get financing to buy a business. And typically when you're buying a business or a real estate or something, an asset that's producing cash flow, the cash flows gets pledged to the bank and the asset gets pledged to the bank, and that itself is the collateral. So what the thing that you're buying, typically an asset goes up in value and it's producing cash flow. So that itself is a sufficient collateral to complete the financing. But because the way the banks are structured and because of the way they do business, they want as much collateral as possible and give out as little money as possible. Because it's a risk issue. It makes the transaction very risk-proof or risk-free. And they want to get as much collateral out of you as possible. And they have many tricks as to how they do it. And I'm going to share that, but I'm just going to first describe what this personal guarantee thing is. So basically, typically you form a company, and that company is making the acquisition. That company is acquiring this asset. It's not you personally. You and the company is different. You and the company that you form are separate entities. So it's not that I am acquiring this company. That would not be a right terminology. The right terminology would be the company that I acquired is acquiring this company. And it is important to make this distinction because in financial terms, there is a world of difference. It's not just a language adjustment. In financial terms, the laws and the structure completely changes. So it's important to understand you and the company are separate, and the company acquires this, and you have shares in this company. So typically what you're buying is enough collateral that thing itself that you're buying goes as a collateral. And a lot of the times the bank is going to ask you for a personal guarantee if you want to get financing. So which means that all the assets that you personally own in your name or through various companies that you own, all of them are on the table for the banks to, in case something doesn't work out, for the banks to have right over those assets. And that's a no-no. But sometimes you're pushed into the corner and it's a risk thing, and some of the people are willing to take that risk.
to make a deal happen, and they don't have any serious assets. So a lot of the people sign. But there are many implications when you do this. And I wouldn't recommend doing it. I was recommended not to do it. But there are times where you can be pushed into a corner and you do it because the deal is a $5 million, $10 million deal, and your assets aren't that much. So, or you have nothing when you're young, and then you do it, So that's, some people do it, some people don't do it. The most ideal structure would be when you don't have to do it, okay? Because you are mixing your personal assets into the deal, whereas you could have done the deal without doing that. So if this is not an ideal scenario, why do people do it? And there is only one reason why people do it, and that is desperation. Because the banks can push you in a corner where you have to do it. I'll give you an example how they do it. Okay, this is something that actually happened. So, and this is a very typical scenario, and I fell for it. And I'm going to tell you this scenario so that you don't fall for it. When you go to a bank for financing, they will give you an impression that they'll be able to finance this deal, no problem. It's a slam dunk, it's easy peasy. And in some scenarios, they will even give you a term sheet. And what will happen is that suddenly when you see a term sheet or when you hear a yes from a banker, you can go crazy, like, wow, I just did this amazing thing and all of this, and it is an amazing thing. But what tends to happen is that sometimes the bank give you an impression that they are really interested, and then once you're on the hook, you are going on telling your board members, you're going on telling the seller, oh, everything is going well, we closed the deal, we got the money, but you don't have the money. Okay, they have just showed an interest. And what that does is, when you do that with the seller or with the board members or even with your family members, your word gets on the line and you get on the hook. And then what tends to happen is they want a due diligence report from a top law firm and an accounting firm. So then you spend money to do the due diligence, and you have money on the line, and then you have spent many months. And so the trick is, the bank wants you to spend a lot of time and money so that you are completely emotionally invested in the transaction. And once you are emotionally invested and once you're on the hook, it kind of happens like a gambler's mentality where you cannot walk away, because if you put like $10, you will be willing to put $20 to get that $10 back and the 20 back. So it's more, once you start investing into something, it's more likely that you will keep investing into it just to justify that initial investment, whether it's time or money. This happens in a relationship. This happens, when you start investing into something, it's very difficult to cut your losses and walk away. And sometimes the wisest thing is to not do a deal and to walk away, instead of doing a deal that's not favorable. So sometimes, no matter how much it hurts, no matter how much it aches, no matter how much it pains, no matter how your family, abuses you, or your board members get disappointed, the morale comes down, the seller, hates you, whatever happens, if the deal is not good enough, you walk away. And you always want to have that walkaway power. And what the bank wants to do is, in the first 5 minutes or in the first few presentations, you do have that walkaway power. But as more and more time passes by, your attachment starts to get wrapped around this deal. Not only that, because the bank has shown interest, you may have stopped working at your job. You may have closed your other business down. You may have stopped working hard, and everything gets dependent on this one deal. The moment you get dependent on one deal, you're fucked. The moment you're dependent on one bank, you're fucked. And I'll tell you a secret. The moment you're dependent on only one girl or a boy,
they have too much power, too much leverage, and typically that tends to lead to unhealthy outcomes. And that's what happens also with the banks, where they put you in a position, they put you in a spot where you've invested all this time, you have invested all this money, and your name is on the line, and they got you in that position by giving you an impression they're interested and everything is going well. And at the last minute of the last day, they change the term sheet. And at the last minute, they say, the credit said that the deal is too risky and we need a personal guarantee for you to go through with this transaction. Otherwise, we can't do it. And they will not do it at the beginning, because then you could just find another bank and it's very easy to walk away. But they do it at the last minute. And that's really a lot of the bankers, they play this game. And I wanted you to be aware of this. And it's actually known as a salami technique, where you start to lock in the person by getting them to invest a little more time, more and more time. And what you want to do is actually the opposite. Okay? You don't want to concentrate your risk with one bank and one deal. So you want 5 to 10 assets that you're looking at a time, like signed term sheets, and you want to talk to hundreds of bankers, and you want to have an abundance. Okay? And then what you want to do is, so now your risk is completely diversified, and now what you want to do is, you want to flip the table, and you want them to invest. You want them to take a car and drive 1 hour to see you. And you will see this, a lot of the bankers will call you in their offices and you're going 1 hour. And a lot of the sellers also did this with me initially, and I just complied because I was so enthusiastic to do a meeting that I would, drive 1 hour away. And I'm investing in the transaction, but for them, they're just sitting in the office. So you don't know their seriousness. So when I understood the game, I started to move bankers from one location to the other, because that gets them to invest their time. And they will fight for you, for your deal harder if they've already invested time. So I do a first round of meeting, second round of meeting, third round of meeting, and I keep getting them invested. And, they go through the same effect that you would have gone through. They see the bonuses coming because of that deal. They see how good they will look. They see how much money they will make from the transaction, etc., etc. So you want to get them salivating and excited, not the other way around. Your position has to always be secure. And this is one of the reasons why I tell my clients, you need to have an external source of income. You need to have money coming in from some place to pay for your basic expenses. Day-to-day life has to be taken care of. Don't do this if you don't have your day-to-day life taken care of, because what will tend to happen is, if your immediate needs are not met, like you're struggling to have food and rent, that's not a good, you will say yes to anything, because you don't have the basics covered. But if you have the basics covered, and this deal was going to be an add-on to your wealth, then, you can walk away, because at least your needs are taken care of. You can easily walk away. And this is what happens in multi-million-dollar deals. And actually, I read, this is actually a thing in mergers and acquisitions, that when I was reading Donald Trump's book, The Art of the Deal, he talks about this, that at a time, he has at least 10 deals going on. Because if he goes and sees a hotel, like a beautiful hotel, like he starts to imagine how he would be there, what kind of celebrities he would invite, how he would impress his guests, and how he can, he would have so many ideas, and he would get completely attached to the deal. And he said that excitement and that attachment is the primary reason why people pay so much higher price to buy a hotel than anything else, because it's the emotional attachment for emotional reasons. And all rationality gets out of the window, and you just want to do a deal. And it's no longer, it doesn't make sense any longer, but you still want to do it. it's because of that attachment wrapped around. And this happened with me with one of the deals where, you know, I got attached to this one clinic and this one owner, and I got to a point where I was willing to sign any kind of deal with him. And that's not a healthy place to be. And I started to become blind to some of the details in the deal that I should open my eyes about. And then I woke myself up and I was like, what the hell am I doing? I have to be willing to walk away. At all times, whenever you're not willing to walk away, you will create problems for yourself and you will do a bad deal. You know, Dan Pena, my mentor, he says, if you want to do a deal bad enough, you'll do a bad deal. So, couple of key points: protect your time, get them to invest in you, and get their time on the line, because the more attached they are to you, the better. Second, be in abundance and always have a walkaway power. How do you have walkaway power? You have more options. Do not depend on one deal, one opportunity, one bank, one seller. No. You need to have, 10 plus sellers at a time you are having a serious discussion with, and you need to have multiple, MOUs signed, and you need to have many businesses that you're talking to on a daily basis. You got to keep that momentum of bringing more and more businesses. Do not stop making calls to businesses. That's the key here. And do not stop making calls to bankers. You always want to keep expanding that network. And you don't know, sometimes what happens is, like, you're working on a deal for 6 months and that doesn't go through, but the one that you found out in the 6th month actually, goes through. And it can happen, that something you've been working on for a long time doesn't happen, and something that you found just now and it was a hot deal and it goes through. It happens all the time. So the key is to continue to generate opportunities, to be in abundance and not getting on the hook, and always be willing to walk away. And the third is, obviously, do not always have a stable source of income paying for your expenses. You're not getting in the business to pay for your expenses. That's not why you get into business. And I know it's super counterintuitive, because we think we get into business to pay for expenses. No, you go to a job, or you go into a sales role for paying your expenses. Business can take expenses. You may be spending money to build a business before it gives you money. So you need to have money coming from someplace so that you are secure, and then business is a gain for you. And it's about getting rich. There is a difference between paying your bills and getting rich. Getting rich can take money and time, and paying your bills has to happen from a reliable source that takes care of you, and that's how you do it. So have the foundation ready, have a source of income where you are paying your bills. Do not let that source of income go. I have had many people come to me and say, I have X amount of savings. Should I quit my job and just focus on this full time? I said, no. Keep the savings and keep the income coming, and do this as an added thing. And once you start becoming successful with this, then you can let this go. But keep the savings and keep this. Don't buy a car. Don't buy something that goes down in value, something that doesn't produce money. Or get a basic car if that's profitable. It's better than going, having a cab or something. Do the numbers, but make sure that you have an external source of income coming in while you do this. Otherwise, that will lead to deal attachment, and it will ultimately lead to bad deals. And so that's my point here, and I'll talk to you soon.